The psychology of market bubbles, why people always fall for them. Market bubbles represent a recurring and intriguing phenomenon within economic history, consistently drawing investors into cycles of rapid price increases followed by sudden and painful collapses. Despite clear historical precedents, people repeatedly fall into these speculative traps, driven primarily by psychological factors rather than purely economic fundamentals. A market bubble occurs when asset prices escalate significantly beyond their intrinsic values, driven largely by speculative investor behavior. This cycle typically starts with legitimate growth or positive news, attracting early investors and driving initial price increases. As excitement builds, psychological factors take precedence, causing further price inflations. Eventually, when prices can no longer be justified by real economic conditions, the bubble inevitably bursts, leading to substantial financial losses. One critical psychological driver behind bubbles is herd behavior. Humans have an innate tendency to mimic the actions of the majority, assuming that collective decisions are safer and more informed. During economic booms, observing others profiting creates fear of missing out, FOMO, prompting investors to enter markets without thorough analysis. This collective action inflates prices even further, creating self-reinforcing cycles. The greater fool theory further explains bubble psychology. Investors knowingly purchase overpriced assets, believing they can resell these to someone else, an even greater fool, at a higher price. This speculative mindset sustains the bubble's growth, detached from fundamental valuation metrics. When investors finally recognize that no new buyers exist at inflated prices, confidence evaporates rapidly, triggering the collapse. Another psychological factor at play is extrapolation bias, where investors erroneously project recent price trends indefinitely into the future. People naturally assume current patterns will continue, particularly during sustained growth periods. This optimistic assumption distorts realistic assessments of market conditions, fueling investment even at highly inflated asset valuations. Anchoring and overconfidence also significantly contribute to bubble dynamics. Investors often anchor their valuation expectations to recent highs, becoming overly optimistic about future price growth. This cognitive bias can blind investors to clear signs of overvaluation and impending corrections. Coupled with media amplification of success stories, this optimism further encourages speculative buying. Historical examples vividly illustrate these psychological dynamics. Tulip Mania in 17th century Holland saw investors driving tulip bulb prices to absurd heights, driven purely by speculative frenzy. Similarly, during the dot-com bubble of the late 1990s and early 2000s, investors flocked to technology stocks with little regard for profitability, captivated by narratives of revolutionary digital futures. When reality set in, many of these stocks collapsed dramatically, causing massive financial distress. The mid-2000s housing bubble provides another stark example. Easy credit and widespread speculative investing drove property prices unsustainably high. Investors, banking institutions, and individuals alike became entangled in optimistic projections of endless growth. When the bubble burst, the resulting financial crisis was global and severe, highlighting the catastrophic consequences of speculative exuberance. Contemporary concerns around market bubbles persist today. Investments in artificial intelligence and cryptocurrencies have recently raised alarm bells. Analysts have warned that rapid speculative investment in AI technologies, driven by exuberant expectations rather than immediate profitability, might parallel past bubbles. Similarly, the explosive growth and volatility of cryptocurrency markets underscore ongoing bubble risks driven by speculative investor behavior rather than stable, fundamental values. Yet, investors are not powerless against these psychological pitfalls. Awareness and disciplined strategies can significantly mitigate risks. First, thorough research and fundamental analysis provide a solid foundation for investment decisions, countering impulsive behaviors driven by herd mentality or FOMO. Diversification is another essential protective measure. By distributing investments across multiple asset classes and sectors, investors can reduce the risk associated with any single market bubble. Maintaining a diversified portfolio helps insulate financial health against dramatic market corrections. A long-term perspective also proves invaluable. Investors who focus on sustained gradual growth rather than short-term speculative gains are better positioned to weather market volatility and avoid severe losses during bubble bursts. Patience and discipline are crucial to this approach, allowing investors to sidestep impulsive decisions driven by temporary market exuberance. Finally, financial literacy and professional guidance are critical. Understanding economic cycles, psychological biases, and historical precedents can help investors recognize bubble dynamics early, allowing strategic adjustments to investment positions. Regular consultation with financial experts can also provide essential insights, helping individuals maintain rational perspectives amidst market turbulence. In conclusion, market bubbles are deeply rooted in human psychology, exploiting natural cognitive biases and emotional tendencies. However, recognizing these psychological influences and adopting disciplined, informed investment strategies can significantly enhance resilience and financial stability, empowering investors to navigate and even thrive through volatile market cycles.